I became a millionaire at 37 and a multi-millionaire by 39. Before that happened, I was $100,000 in debt and I owned absolutely nothing. And even if I did, I wouldn't have known if I was doing it right. Should I have invested in the stock market, real estate, start a business? What about crypto? What changed everything for me was simply understanding the order that money should be invested. That's why in today's video, I'm going to show you the exact order that I personally use to start building wealth. This is a framework that took me from $100,000 in debt to millionaire in about 5.5 years. Step number 1, your emergency fund plus debt simultaneously. Now, the first thing I focused on was two things actually at the same time: building an emergency fund and paying down debt. And I did both of these while using the system I call the 10-10-10-70 rule. This rule tells you exactly what to do with every paycheck. 10% goes to investing, 10% to savings, 10% to giving, and 70% is what you actually live on. Now, when you're in debt, the 10% that normally goes to investing will now start going to paying down debt plus the minimum payments you're already making. At the time, I was focused heavily on paying off about $100,000 in debt, but at the same time, I was slowly building my emergency fund. So while the debt was going down, my savings was actually going up. Now, here's the key: build your emergency fund to cover 3 to 6 months of your monthly expenses, not income, your expenses. By the time my debt was actually gone, my emergency fund was basically already built. And that was a huge moment because now, instead of money leaving my life every single month, I suddenly had cash flow available to start investing. Step number 2, tax advantage accounts. Once my debt was gone and my emergency fund was built, the next thing I focused on was tax advantage investing, because one thing that I realized early was taxes will absolutely destroy your ability to build wealth if you don't understand them. So the next place I started putting money was into things like my Roth IRA or retirement accounts like my 401k and other accounts that allow my money to grow with tax advantages. Because if two people invest the same amount of money, but one of them gets taxed less, the one paying fewer taxes wins over time. Now, let me give you an example. Let's just say two people both invest $500 a month for 30 years. That's $6,000 a year. Now, at 10% return, both accounts grow to about $1.13 million. But if one person invested through a taxable account and paid capital gains taxes on the growth, they could easily lose $150,000 to $200,000 just to taxes. Meanwhile, the person investing inside, let's just say a Roth IRA, keeps every single dollar of that growth tax-free. Same investing discipline, very different outcomes. Step 3, brokerage accounts. After that, I started building what I call my core investing account, which is my brokerage account. This is where I started investing consistently into the stock market, and I didn't try to do anything fancy. I wasn't day trading. I wasn't chasing hot deals. I was simply investing into low-cost index funds that track the S&P 500. Now, these are simple funds like Vanguard's VOO or Fidelity's VXAIX or Schwab's SWPPX. Nothing complicated, just consistent investing. Because one of the biggest things that I had to learn early was compounding. Now, when you allow money to grow year after year, the result starts to become powerful. Remember the example I explained before, that if you automatically invest $500 a month for 30 years at 10% average returns, you would end up with about 1.13 million. Now, here's the crazy part. You only contributed about 180,000 of your own money, while the other 950,000 came from compounding. But most people delay this step because they feel confused about investing. And we know that a confused mind does nothing. So just start. Okay, step number 4, real estate. Once my investing foundation was in place, the next thing that I focused on was real estate. And I had a very specific goal that I wanted to hit. I basically wanted to build $10,000 a month in passive income. And at the time, my monthly expenses were only like $6,000 a month. So in my mind, I'm thinking if I could build to $10,000 a month of passive income, I would essentially eventually be free. So I just started doing the math, and I figured that each rental property would hopefully produce at least $500 a month of cash flow. And if that was the case, then I basically would only need about 20 properties. And if I could figure out a way to buy 5 of these properties a year, that would only take me about 4 years to reach that goal. And at that point, I'd have $10,000 a month of passive income, plus the properties themselves would increase in value over time, raising my net worth. So my entire focus became on building a real estate portfolio. Step 5, private investments. Now, after your foundation is strong, you can start exploring private opportunities. Things like private lending, real estate syndications, even things like private equity. Now, these deals admittedly can produce higher returns, but they also carry higher risks. And that's why they should come later in the order, not first. See, I always wanted to do this stuff first, and that's why you would get in trouble. But as my network started to grow, I eventually started to get opportunities to invest in private deals. And one of my first opportunities came in real estate from a buddy of mine. He was working on a project and he was expecting a home equity line of credit to come through, but it never did. So suddenly he needed about $100,000 to quickly keep the project moving. And he asked if I knew anybody that might be able to lend him the money. I told him, send me the deal, let me take a look at it. And after reviewing it, I decided to do my first private lending deal. We literally drafted up all the paperwork, put all the legal protections in place, and that deal turned out to be one of my most successful deals to date. And that experience opened my eyes to an entire new world of investing, private lending, real estate syndications, all kinds of opportunities started appearing once I was in the right rooms. Step 6, speculative investments. Now, the last category is what I call speculative investments. These are going to be things that are like crypto, investing in startup companies. These is when you hear about angel investors, private equity, things that can make you a lot of money, but also have an extremely high chance of losing money. And that's where a lot of people make really big mistakes, is they actually start here, because speculative investments are exciting. They sound fun. They're cool to talk about. You get to say things like, I invested in a robotics company, or I invested into this startup AI company. But the reality is the failure rate in speculative investments are extremely high. So for me personally, I never put more than about 3 to 5% of my investable money into speculative deals, because speculation should never be the foundation of your wealth. It should be the smallest part of your portfolio. So let's recap. So the order I followed looked like this: emergency fund, pay down debt, tax advantage investing, core market investing through my brokerage account, real estate investing, private investing, speculative investing. And when you follow a structure like this, building wealth literally becomes inevitable, because instead of trying to do everything at once, you simply focus on the next. I do this, and then I do this, and then I do this. So if you've enjoyed today's video, then watch this next one. And if you haven't yet, click that little subscribe button to join the channel family here. And let me know what questions you have that I can answer on future videos. And of course, until next time, stay with me. No lazy money.